You need to watch this video before you buy your next investment property, because what looks like a safe bet now could quietly cost you thousands in the future. We've seen it too many times. Investors rushing into flashy cities only to find their yields shrinking and diminishing, their properties not increasing in value the way that they should be, while regional cities surge ahead in the returns. At RW Invest, we've been doing this for over 2 decades. Clients trust us to look past the market noise and just focus on the core principles and fundamentals of a good quality investment and achieve meaningful long-term growth. In this video, we're going to look at what to avoid buying in 2026, where the real growth is expected next for the UK's property hotspots, how to match your property strategy to your financial goals, what I believe you should be avoiding buying in 2026. Investors assume that buying into expensive areas full of high net worth individuals and fantastic flashy properties would lead to a great investment. But in fact, this couldn't be further from the truth. Property prices in those areas are so high, and rentals not keeping up with the property price increases mean yields in central London over the course of the last 10 years have diminished to be lower than the returns you would be paying on the mortgage, which would mean that monthly you could be making negative returns just based off the charges you're paying out versus the money that is being brought in by the asset you've purchased. One common theme that we're seeing amongst our investment clients is that many of them have made absolute fortunes in the central London postcodes over the course of the last 10 or 20 years. These clients have seen booms in property values in those areas and made fabulous returns on their initial investments. Now, their investments have stagnated. Over the course of the last 3 or 4 years, property prices have flattened right out and in some cases even gone down in value. We've had many clients saying to us, I've done fantastically in the London property market, but it's not returning to me what it once was. I'm now looking to sell up my portfolio in London and deploy that same capital into other cities in the UK where the money works for me a little bit harder. What do you suggest? We suggest moving their money into some of the more regional cities where the big booms are still happening and the bigger appreciations and yields can still be found. You could spend £400,000 and above on a studio in Zone 2 in London and see minimal growth over the course of the next few years, whilst somebody spending £200,000 on a prime property in L or M1 could see their property value increase by 20% at least during that same period of a few years. But not only that, your average yield in Zone 2 in London will sit somewhere between 3 and 4%, whereas when looking into some of the more regional cities, you can see yields anywhere between 6 and 9%. The moral of the story, don't buy the postcode just for the prestige. Buy a postcode based on the performance metrics. If your investment is not outperforming inflation and your mortgage costings, then it is simply a liability to you and not a real investment. A common trap that we regularly see investors falling into is taking a lot of the literature that they'll see online as gospel. They see really fancy literature and really high-end eye-catching CGIs. Those clients fall into the trap of making emotion-based decisions for their strategy. You have to take the time to do the research, collect the data, and make informed decisions with no emotion involved. You risk overpaying for a property in an already saturated market in an area that has already reached the peak or ceiling of its boom. And when that market begins to cool down, you're then stuck with an asset that you overpaid for that is underperforming, and your capital is just not working as hard for you as it could have done. Short-term hype might create some kind of buzz. Of course it will, but it's long-term fundamentals like employment areas, big growth potentials, major regeneration projects that will actually drive the main body of the returns on your capital. Before you commit to buying any property at all, just ask yourself, what does the data actually tell me? Look at the employment growth in that area. Are there any big new employers set to come in? Are there major changes in transport links, the infrastructure of businesses in that area? Are there plans within the region to grow and expand on particular sub-districts of a major city. Also make sure to check the rental demand and what's available in that area at the time. You want to make sure you're buying into an area that is not saturated and really has a genuine undersupply. That means your asset is going to be easy to tenant and be able to be rented for a premium. A great example of this is the work we've done in the Baltic Triangle in Liverpool city centre over the course of the last 8 to 10 years, where we've put up many residential buildings alongside lots of the new serviced offices. Around us, we've then seen major changes in leisure, restaurants coming in, hotels, bars, and that particular area has a brand new train station currently going through its journey to be built that when completed, we should see property values increase overnight. Now, we've spent countless hours scouring the market across the country to look for where is the ideal next hotspot area for you to place your investment capital. And if you want to cut through the noise and find where is the next best place to put your money to make the strongest returns, use our handy investment calculator, which should give you clear framework using analytic data on where that next best hotspot is going to be. The link is in the description below. What you should be focusing on for your next investment in 2026. Almost always, smaller city, if bought correctly, will lead to significantly higher returns. A really good example of this right now is a client of ours who is looking currently for a property in Warrington. Warrington is an area that is absolutely not on the radars as one of the next big hotspots. But this particular investor was really savvy, looked at the data, saw the announcement of the new Northern Arc railway line, where we're going to have major upgrades to the transport links between Liverpool and Manchester, with a stop in the middle at Warrington. Also, new shopping centres going into the area and a variety of new amenity and office spaces lead to Warrington being an area that we could expect to see jumping in value over the course of the next few years. The data suggests massive property price growth and extremely strong yields, with a real shortage of genuine high-quality properties in the area. All of those things economically lead to the potential for the best possible returns when deploying your capital there. And not only that, properties in those areas are just that little bit cheaper to purchase as well, which means the barrier to entry for you as an investor is significantly lower. In almost all circumstances, cities like Liverpool and Manchester are outperforming London significantly. The data shows us that your average property price in a city like Liverpool or Manchester is set to increase by 31.2% by 2029. The reason for the big surges in pricing is, of course, because of the major regeneration happening in both cities. In Manchester, we've had projects like Media City and a variety of other big-scale regeneration projects across the city that have really pushed those property prices and brought new employers to the area. With Liverpool, we have projects like the Liverpool Waterways project, which is actually being done by the same developer, Peel Holdings, where they're spending an approximate £5.5 billion on regenerating Liverpool's business district. This will see millions of square foot of new commercial spaces, big new employers entering into the city, and major changes in the business district itself. Property prices in and around that area will really feel the capital appreciation swell from those other projects. Another really important thing to do is to explore the different ways you can buy property in those areas. For me, one of the key ways to buy property is to buy off plan. It comes with a vast array of benefits, where you buy an asset during the build phase, receive a below market value price of 10 or 15% below what its completed value will be. A lot of these buildings come with facility packages, including gyms, spas, cinema rooms, which does a variety of things for you as an investor, pushing the rents to the highest possible level and ensuring that void periods are as low as possible because of the demand to live in one of these luxury buildings. You're paying a fair rate for a premium product using the fundamentals and the data. And with rental growth expected to continue and accelerate during 2026 in a lot of the northern cities, it means the potential tenant pond you're fishing in is much bigger with much less noise and distraction, keeping your property full for longer. So, when shopping for off-plan investments, look for the off-plan buildings going up as close to the major regeneration projects as possible. And here's another fact that will separate high-performing investments from very average underperforming investments. Investors that focus solely on capital growth areas, they sometimes will forget the demographics required to be renting a particular property type in a particular area. And if they don't have the right demographic of tenant to match the property that they're putting into that area, it becomes harder to rent and a lower quality investment. A great example of this is a good friend of mine that bought himself a terraced house in a suburban area fairly near to Manchester. He bought it in a dilapidated state and decided that what he wanted to do was to renovate the property to add value and then rent that property out for a premium. He spent an absolute fortune regenerating the property. This area was ever so slightly economically deprived and just not right for such a high specification of property. What this led to is a bit of a dilemma. Does he leave the property empty until he finds somebody willing to pay, or does he drop his rental price to make it so that the property was rented? Naturally, he had to take option 2 and get a tenant in the particular apartment. But it was a big learning lesson for him, because what could have been a great investment if he'd done a cheap job of the refurb or bought into an area that when he did the refurb could hold the higher rental value. Instead, he settled, put the tenant in there. The tenant is over the moon because they have a cheap deal on a property too nice to be renting for that value. But his returns shrank to very little for a lot of hard work. Young professionals are the backbone of the rental market in this country. They're reliable tenants, they value quality, and they're absolutely willing to pay a premium to be able to have a good quality product in the right location for them. And right now, young working professionals moving into regional cities to find their careers and base their lives from. Many of the big companies we're talking about moving their offices away from London to take advantage of the cheaper rental rates and slightly lower wages in other parts of the country. The other key driving factor, since COVID, we are now seeing remote working becoming more and more common. Someone could be working for a high-flying company in central London, being paid high-flying central London wages, but able to live in one of the more regional and affordable cities. Cities like Birmingham, Liverpool, Manchester, Nottingham, or even Sheffield offer significantly better quality of living pound versus pound. It's really boosted the tenant demand in a variety of other cities across the UK. This is not just good for rental demand, it's also good for capital growth. Any of the cities like this that are now being flooded with more and more professionals just leads to significantly more competition and traffic in the markets. And naturally, when an area sees more and more professionals wanting to live there, the businesses will then follow them into those areas. When new businesses come in, the infrastructure around those new businesses improves. We see rental growth across the country increasing by an estimated 3 to 5% per year. In different areas, the percentage of growth will be higher or lower based on basic economics of supply and demand. In areas with high demand and low supply, the rental projections will boost at a quicker rate than areas the opposite way round, where there are plenty of properties for people to look at. The advice I'd give to you, look for areas with growing tech sectors or new major employers coming in. Brand new big developments of new offices, new university links. Check the employment data and migration patterns. Think 25 to 40-year-olds. They're going to be most likely your target market. If they're moving to areas like this, it's a strong indication of good market demand for tenancy, good potential appreciation because of the extra competition it brings into the market. A great example and evidencing of where I believe would be a fantastic location for your next investment purchase is the north side of Liverpool city centre. There is going to be fantastic new office buildings set up. And if you can buy into one of the areas very close by, you should see massive appreciation swell and the potential for an investment that's going to be full all the time, because of course there are going to be a lot of new people needing to reside and work in that area. And we're also building some buildings there ourselves because we've identified it as one of those next massive boom hotspots, and all of the data supports it. With that being said, capital growth doesn't just happen by accident. It happens in areas where the fundamentals are already strong and are set to get stronger. Confirmed major infrastructure projects, large-scale regeneration projects, major employment hubs, population growth. All of these factors economically together give you a greater chance of success. Areas like Liverpool and Manchester are seeing constant growth because of the fundamentals that we already discussed in this video. And those fundamentals give a framework and foundations to build yourself a fantastic investment portfolio. Another thing I'd recommend before you buy any property in 2026 is to write down exactly what your goals and objectives are and exactly what you're trying to avoid when purchasing, and then plug the data into the framework that you outline to give yourself the best possible models of which direction you should go in to make sure you get that success. If capital growth is your major focus, go after the areas of major regeneration. Put yourself right next to those multi-billion-pound projects, and you will see your asset increase in value faster than if you put your money into areas that don't have major regeneration happening now. If cash flow matters more, go after the areas with the bigger yields. Go after the areas with the major shortages of supply. Go after the areas where tenant demand is at its highest and isn't met by what is currently in the market there. But if you wanted my real advice, you've got to find that good balance of the two things. And I would definitely say the Northwest right now, with the shortage of property and the great opportunities to make really good appreciations and yields, is exactly where the data should point you. You can understand the strategy and you can understand which is the best location to focus on. But if you don't implement and execute the strategy efficiently, things can still go wrong. And that's why we offer free strategy calls and virtual consultations to all of our clients to be able to outline their goals and aspirations and their needs from their particular investments for us to match up with a variety of properties that meet those goals. We'll walk you through specific areas and all of the fundamentals of those areas for you to then do some research on yourself. And if everything lines up, we'll help you get to that purchase point of whatever property it is you're looking to buy. To set up a virtual consultation, please click the link in the description and book an appointment with us today. Knowing the strategy is only step one. The next step, of course, is identifying which areas work within your strategy to give you the best possible return on the funds you're investing. Make sure you tune in next time to watch the video on which particular areas and which buildings in those areas I would be looking towards if I was starting my investment journey from scratch in 2026. I'll see you next time.